channel. Welcome back. We have a value investor, former trader. We're going to talk about how he got started, what his what his strategy is today, how he sees the market. So join us. Let's get into it. Today we're going to get your market IQ up, right? That's the point, to get your IQ up, not your reading score, not your math score, but your market IQ. That's what we do here, all right? Joel, welcome to the channel. How you doing?
I'm doing well. Thank you for inviting me. I really appreciate the platform and time here.
100%, man. I talked to Joel earlier last week, and he had a lot of information. Most people kind of just say random stuff, but this guy seemed like he had some good experience. So that's why I wanted to dive in, see what he knows. Joel, how did you get started in the market?
Well, I went to business school in the Carlson School in Minneapolis, Minnesota. Very, very, very good school. Got my bachelor's and master's in business with a major in finance and a minor in economics. So I got my start in the financial markets in the mid, I guess you can say the mid to late of the tech bubble of 2000. And I started my career first as a trader. I was a commodities trader, mainly focused on the rise of China. So copper was a big story back then, as China is the biggest importer of copper. So I was mainly trading copper and oil, and those were my two focus there. I also dabbled with some bonds. So I was trading the German 10-year bonds, that's how I really got my career started. Mainly, I didn't go to New York City. I was trading at Philadelphia. I was moving city to city, actually. One time I was in Philadelphia. Another I was in San Diego, San Francisco. So I wasn't in the big hub. I was mainly in the medium sized boutique investment firms.
Okay, and was this back when there you traded on the floor?
No, I wasn't a floor trader. I mean, I was a proprietary trader. So mainly, this was the start. This was when computers were really starting to, I don't want to use the word infect, but this is when they really started to kind of dissipate in the trading world.
Okay. Wow. All right. So
So
you
I was trading
started. You were
for a firm. I was trading their money, and I was an employee.
okay. Can you explain to the audience what a prop trader is?
So a proprietary trader is simply a proprietary trading firm is a firm that is an investment firm, but it's mainly short-term trading. So it pulls a lot of money from a lot of different investors, and it kind of it's a way for big money managers and rich people to actually diversify their net worth. To get into different, I guess you can say. A different side of the market that gives them a different risk to reward aspect, right? And so that's mainly what a proprietary trading firm is. It's mainly active trading. It's not investing. It's short term focus. There's mainly event driven technical analysis, and I was more of the event driven trader, mainly focusing on central bank data. So I would trade the Fed, right? The Fed's words, and mainly focused on geopolitics, right? So if something big happens, I would be the first to know, and I would place trades based off of that.
Is it how much different is it trading the Fed? Like, I'm sure you lock in a Fed day. How much different is it today when you hear the Fed versus not when you hear the Fed, but like how you trade around the Fed? How much different is it today versus how it was back? Like, what was this, the 90s, early 2000s? Early 2000s?
2001, 2002.
Who was the Fed chairman?
The Fed chairman at that time was Greenspan, Alan Greenspan. He was mainly he had to deal with the I'll never forget, he really had to deal with the two different environments, the credit environment and also the tech environment, right? And
Okay.
this is the first time anyone has ever seen this in the world, right? Tech was just starting up, right? It was a new thing. You'd see companies put .com behind their name, and they would rally 100, 1,000%, right? So it was that kind of environment.
Okay,
Mainly, I
I
guess
see.
you would say reminiscent of what we saw in 2020, 2021. So yeah, he was Alan Greenspan, really tremendous guy. I applaud him, especially the way he handled the whole situation.
Awesome. Now, there's this concept that kind of goes around the market, and I wanted to, since you have experience with it, and that concept I try to, well, I've learned from this. It's not like it came from me. Is that the reason one part of the reason that the Fed could orchestrate a soft landing or things are different is because they communicate a lot more today than they did in the past. Is how true is that?
Oh, absolutely. I mean, that's true. I mean, you look back in the, I don't know the specific time, but the 90s and the, the 20th century. I mean, the Fed. I mean, today we have the Fed coming out and they will release their press and their, on their website, they say we raised rates or we lowered rates by this amount. 30 minutes later, the chairman will hold a press conference. And so it's a very open, very transparent organization now. But back then, it was very closed. I mean, they wouldn't hold a press conference. They wouldn't even tell you what the interest rates were, right? You just had to figure that out by how the economy moved, right? So now they're much, much more transparent. And so markets really,
Wait,
markets are
wait, wait, wait,
volatile.
wait, wait, wait. Let me interrupt. They didn't even tell you what the rate
No,
was?
no. You look back in the 80s, 70s, 60s, they wouldn't even tell you what the rates were. We had these Fed watchers. So these people who get paid to determine how much the Fed raised interest rates by, just by kind of observing what the economy did, what the financial markets did, right? So they wouldn't even tell you they would just raise rates and they wouldn't tell anyone, right? So
What?
it was a very different environment back then, and this was before my time, right? But and so yeah, it's much more transparent now.
See that then this is why to the audience, this is why I say this is not the same market as it was before. The Fed is much more probably influential to the markets. It's instant. But the fact that they didn't even tell you what the Fed funds rate was, and today you see it like literally when it comes out, and like this is not the same market, right? That market, that bias is just not there. There's a lot of thank goodness we have Joel here to actually explain that. I had no clue, man. Joel, I wanted to ask, so like, what got you into the markets? Like, where did you grow up at? If you don't mind sharing, how'd you grow up? What got you first interested in trading in the first place? Like, how'd you grow up? Where'd you grow up? And how did that work out?
So I'm an immigrant actually to this country. I moved here when I was 6, 7. Moved from South Africa, and so I came to Kansas. Well, first I landed in Dallas, and I was there for about a few months. At the age of 7, 6, and moved to Kansas. And I saw in the library one time at, I don't know, 6th grade, 7th grade, maybe 8th, right? I know it was before high school. Saw a book by a guy named Benjamin Graham, and we talked about this a few days ago, right? Yep, The Intelligent Investor, and that was the first book I saw about investing. And I wasn't raised in money. I didn't come from a family that was interested in the financial markets, right? Just like anyone else. They weren't really paying attention to this, and they had no reason to. But I saw this book in the library, and a librarian recommended it to me, and I read it, and I fell in love with the whole idea of it. Right? I mean, it's. I truly love doing it. I mean, it's even if I was paid, say, minimum wage or a little bit above minimum wage, I would still be probably an accountant or an investor. Right? I mean, it's just the passion. Right? It's just the passion I have. It's something I love doing. Right? And the money's great. So.
Now, Benjamin Graham did promote no trading, don't trade. So why did you turn on your man? No, I'm just kidding. How did you get into like more prop trading versus investing? I know a lot of people find their way into that, but it's like he warn Benjamin Graham not to trade and to be more of a longer view investor?
He did. He did. But the reason I got into trading was so first and foremost, technology was being introduced to the market, right? I mean, so I knew that this was a big opportunity in the market, right? I mean that now anyone can be a trader. Anyone who has a computer can be a trader, right? So the availability of information, the availability of tools, and connection with other people, it was just available, right? And in the beginning, I mean, my idea was after I graduated from college, it was you know trade for some years, and then after accumulating a good sum of capital, then transition into more of a long-term investor. So my long-term, goal was still value investing, long-term oriented, but it's just the way of getting started and getting started on this was, accumulating capital quickly in a very risky way, which is trading, right? I mean, I had no backer, I had no, someone who would give me money or whatnot.
Yeah, that makes sense. So basically, the opportunity, the kind of the culture changed, the technology changed, and it presented an opportunity, and fortune favors the bold. So you had to take that opportunity. I'm guessing in back in Benjamin Graham's day, there wasn't. It's not like you could jump on your phone and start trading and get into something or learn
Oh,
on YouTube.
absolutely not. Absolutely not. I mean, back then, I mean, that was a pro and a con also, because information was very scarce. I mean, you had to go to, you had to get a news, some, I don't know, some, you have to get the financial statements, right, the income statement and the balance sheet shipped to you by the New York Stock Exchange or whatnot, right, literally through your mail, right. Now we can
Right.
just go online and get it. But so it was difficult in that aspect of getting your hands on information. But that was also an upside in that if you got your hands on information, and if you curated a way of actually getting useful information, right, and you were able to decipher these numbers and kind of, you know, pick them apart and just play with them, if you found an opportunity with that, you really were the only one, right? I mean, since because there was no competition, right? No one else was doing
Right.
this, and so it was a double-edged sword, but it worked fantastically for Ben Graham. Really, I think he was returning somewhere 50%, north of 50% per year.
Right, right. That's what I love about the markets too, is you can deploy any type of strategy. You just have to be good at it. You have to know, not any type, but you got to be able to adapt. It's a lot of creativity, and there's so many ways to actually do it. And that kind of brings us to the next topic here, which is how did you start to form you're known as a value investor, right? You use fundamental analysis. How do you form your analysis? Where do you start when you want to analyze a trade, right? A trade or
Yeah,
an opportunity.
just my
How do
whole
you even start?
process.
Yeah, what is your process?
Well, my process typically it's very in depth. It's very in depth, but it's also pretty loose at the same time, right? So my process usually starts with a screener, right? I mainly screen for stocks just to kind of filter out different companies and different industries and whatnot, right? And just kind of get down to the core of what I like and what I like to see. Now, it doesn't mean I'm going to invest in these companies, but it just means that this universe, this 500 stocks, right? This universe is the universe I'll be limited to, and this universe that I'll mainly focus on. So mainly, I like to look at price to free cash flow, price to book, price to sale, EV to EBITDA. I like to look at these ratios and just kind of get these ratios at a very, very, very low amount, and then that's when I kind of start picking the company apart.
Okay.
Well, I mean, I have a very in-depth way of this. I mean, I don't know if I can get it for you.
I got a stock screener right here. We're gonna go over it live. Actually, I don't know if I have all of the EBITDA, like price to EBITDA. I don't have that, but we do have price to book. What do you want to see when it comes to price to book? Under two. What do you want to see?
Below one.
Low. Okay. Anything as low as possible.
Yeah, I generally like to see it below when I like the company to trade below its book value. As a matter of fact, I go a little bit deeper and I'd like the company to trade below its tangible book value. So if a company has, say $500 million of assets on its balance sheet, and 250 million of that, half of it, it's intangible assets and goodwill. I generally like to just cancel that out because I don't want to look at it. I don't care for that. You can't really value that stuff.
What about market cap? Do you have a specific market cap?
So generally, I'm a micro small cap investor, so I don't go above $1 billion, right? I very, very, very rarely. As a matter of fact, right now in my portfolio, I have 40 positions, about one or two are above a billion. So generally, my sweet spot is below a billion, but in the low hundreds, low hundred millions.
Okay, you tell me. You tell me which one of these that you'll focus on. So we did, we did micro caps. Where you guys, it's
Well, I
live
mean,
right now.
if you want to look at a better screen or uh, what's it called?
Tell me, yeah, tell me what to go to.
TradingView. TradingView is a fantastic screener. I mean, I have my own screener, Seeking Alpha and Bloomberg and Icon, but one of the freer ones.
All right, tell me where to
Screener.
go. I've never used their actual screener on here.
Oh, yeah, the
Um,
free. They're the best free screener really.
oh really? Okay. Let me see if I can get there. Trading View screener. Let me see. Do I have to get out of? I think I have to go to home, and then let's see. See, where would the screener be at?
So click on the left side, the three little, yeah, and then go to products, and then just hover over there and then go to screener, yeah,
This
and
is a
then the first
live
one, stocks.
stocks. Yo, this is literally a live process. You guys better be paying attention for fun for this information. So, okay, so now what?
So and then just scroll to the right side, yeah, go all the way, and then click on the three, yeah, that one. And then you can look at price to sales. I like price to sales. I like really low price to sales. I mean, I like my companies to have operating leverage. I want my company to, if margins decline a year, if margins decline another year, I like my company to have some room to actually, some breathing room in general, right? So, price to book, I generally like to see it at below zero point 0.5 and below zero point 0.1. So just one.
Okay, so I'm gonna click on price to book. I'm gonna click on. Oh,
Price to
this is
sales.
okay. Price to sales. Let's see. Where the hell is price to sales at?
You can just
There it
search it
is.
actually.
Oh, you can search it. Okay. All right. So price to
EV to
sales.
EBITDA, I like EV to EBITDA. I mean, EV to EBITDA is really EV to EBITDA is a more comprehensive PE, right? I mean, PE just looks at the price and the earnings, right? And the earnings are, they take into account many different things like depreciations and amortizations. And these are non-cash impairments, right? So it's a little bit clunky in my personal opinion. So EV to EBITDA, I like it because it's much more comprehensive. And price to free cash flow. I value cash a lot. I like cash. Cash is very important to me, right? I generally like to see it at below 5, but just as low as I can get. I also get a little bit lower than that. You can just search it up if you,
Right here.
well, no, if you click on the three dots,
Oh, okay, okay.
yeah, you can
Oh,
just
there we
search
go. There. So is it called price to EBITDA or is it just EBITDA?
EV to EV. Just search up enterprise. It doesn't have the acronyms.
Oh,
Yes,
okay.
it's the first
Enterprise
one.
value to EBITDA. Okay.
Yes, first one.
Ooh, this
Trailing
is
12 months is always good for me.
trailing
Uh,
12 months. Okay.
and then price to free cash flow, very important. Oh, you search it on the same place.
Oh shoot, my bad. Sorry, I've never used this one. Price to free cash flow. Okay, price to does it pop up on
There it
there? There we
is,
go. Trailing
TTM.
12 months. Okay.
Yeah, and
Nice.
yeah, that's generally the three indicators, the three ratios I like to look at, and then
All right,
you
hold
can
on,
adjust.
before we get to that, let's
Yeah,
how about you give us a little hey, I'm learning here too.
hmm.
I'm not a
What
value
these
investor.
what they represent or
Yeah,
whatnot.
price to book. What is the price to book
So the
represent?
price to book is essentially the price of a stock and comparing it to its assets, right? Book means assets, really. Just it's synonymous with assets, right? So
Right.
if a company traded at, say, a company had 500, $100 million on its balance sheet of assets, right? So this could be cash, inventory, right? Whatever that the company owns, right? Let's say it had $100 million, but the share price was $10, right? And the market cap was, I don't know, $10 million, right? This would bring you to a price to book of a price to book of 10, right? It bring you
Right.
to a price to book of 10 because the market cap of the company is 10 million, but it has I'm sorry, if the market cap of the company was $1 billion, but it had assets of $100 million and the share price was $10, it bring you to a price to book ratio of 10, right? So it's just comparing what the price of the stock is to how much assets the company has. Assets being what the company owns.
Okay, and does that kind of represent kind of like how pricey it is versus the actual assets it has? Like if somebody has if the price, let's say there's two stocks, they have the same price, but one of them has a lot less assets, that one's going to be less valuable.
Let's say that again, the last part.
So two companies have the same amount of price, right? The price is the same,
You,
same
you
market
mean the
cap.
market cap is the
Yeah,
same?
same
Yeah.
market cap, same price, but I mean obviously hypothetical, but
Yeah.
one has way more assets, that one's going to be more valuable.
Oh yeah, that's absolutely. I mean, it's it's what the company owns. You'd want your company to own more than another company that's worth market wise about the same, right? I mean, uh, for example, if a company had assets of a book value of $1 billion, but the company was worth, I don't know, $5 billion, that company would have five times price to book because it's trading at 5 billion and the book value is 1 billion, so it's five times price to book. Now, if another company had 1 billion in assets, but it was the market cap was 10 billion, it would be 10 times to 10 times the asset value or price to, of book value.
So typically is the book value, let's say all else held equal, meaning the two companies have the same market cap, the same price, you're looking for a smaller book value, right? You want it to be lower in general.
You mean the price to book value
Yes,
ratio?
the price to book. Yes, the price to book. You want
Generally,
that to
yeah,
be
you want it to be low.
generally
Generally, I like it lower. Yeah, I mean,
right.
well, not
Okay.
even generally. If you like price to book, if you like that ratio, right,
Hmm.
depending on what kind of investor you are, yeah, you'd want it to see lower. You want to be as low as possible. All else being equal, again.
Because the lower the price. Now I'm trying to think this through for
The
myself.
lower the price to book value, it means that the market cap of the company is closer to the book value, right? I mean,
Right.
let me give you an example. If a house was on the market for $500,000, but inside the house it had artifacts, maybe a chandelier, maybe whatever, right? Some artifact inside, maybe a couch, whatever, right? And the assets, the stuff inside the house was worth $1.5 million, hypothetically. The price to book for that would be three, right? Because the house is trading at 500,000 and the assets are 1.5 million, right?
Hmm.
So compare that to a house that has, I don't know, compare that to a house that's worth 500,000 but it has assets of $500,000 worth inside the house. Which one is more valuable?
The one that has more assets in the house.
Yeah, I mean, the one that has a better artifact, the one that has a better chandelier, right? The one that has a better refrigerator, right? And so
Right.
that's generally you want assets to be higher, and the price that these assets are trading for, you want it to be lower.
Hey, that's a really good comparison. So you think about a house, same price, same size, but one has way more inside assets in the house that are more valuable. You want that one. That makes that's a good. There you go. Thank you.
Yeah, all else being equal.
All else being equal. All right. How about price to sales?
Price to sales is just the revenue, right? Sales and revenue are same word, so it's just the revenue, right? And the price, right? So
Right.
generally, yeah, go ahead.
Yeah. So price to sales, you're saying is similar to book value, except for you're looking at the price comparison to how much revenue they're actually bringing in. Are they bringing enough? Are they bringing in enough revenue that kind of aligns with the price?
Yeah, no, I mean it's when you're looking at price to sales, you're looking at how much sales are you getting per dollar, right? So hypothetically, if a company's sales revenue is $100 million, but the company's worth $10 million, the company's price to sales would be zero point 0.1, right?
Okay.
Because it's trading at 10% of its sales, right? Its sales are $100 million, but the market cap is $10 million, right?
Right.
And so it's 10% of sales, and the price of sales would be point 0.1 or 10%, right? But then another company that has $100 million in sales, but is trading at $1 billion, well, the price of sales would be 10 because it's trading at 10 times, literally 10 times to its sales, right? Its sales is 100 million, but it's trading at $1 billion. I mean, 100 million times 10 is a billion, right? And you don't
Right.
want it to be lower because you don't want your company to have some operating leverage, right? You want
Mhm.
your company to, if there's an economic downtrend, if there's a some sort of a some sort of, because the market is always fluctuating, right? And
Right.
financial conditions and economic conditions are always fluctuating, right? So if things get better in the macro wise, this company could really bring in a lot more value, right?
Mhm.
If margins are the same, if operating margins are the same, if net margins are the same, but sales, if but sales are 100 million, right? If they're
Right.
trading at point 0.1, 10% of sales, they can take a lot of initiatives to actually, they wouldn't even have to really do a lot. They wouldn't have to acquire many different customers. They wouldn't have to, spend a lot of money on marketing or whatnot. They can just cut costs here and there. They could maybe cut, some employees and then increase their margins, and that could do the job of really bringing in profit. So it increases operating leverage.
Are we talking on sales? Are we talking like the last 12 months of sales, like the year? Is this like a yearly
Well,
sales?
I like to look at sales of just 10 years at the very least, maybe 5 years worth of sales, and
The
just kind of.
average?
I like to look at the average, the 3 year average. I like to look at the trailing 12 months, last
Okay.
year, just kind of get a
Okay.
feel for it. But generally, when I'm looking at a company, I want the sales to be stable or improving, right? Stable is
Right.
fine, right? If they're not increasing and they're just staying about the same, that's fine with me, right? Uh, it means at least the management isn't, destroying the company.
So whenever the price to sales is, you just don't want it to be distorted and out of whack. You want it to be consistent. So if that price is out, you would say the value of it in general, the value is stretched. If the price to sales is too big, then you're seeing the value is actually really stretched. Does that make
Yeah, I
sense?
mean, because I mean, it's too stressed. If you're trading at 10 times the price to sales, that's very, in my opinion, in my humble opinion, that's too stressed, right? I mean, as a value investor, that's way too stressed because there's no reason you should be selling $100 million worth of goods and services, but you're worth $1 billion. It doesn't make any sense to me, right? You should be worth a lot less than that. I would personally buy you at a much less price of sale than
Let's look
that.
at an example here. So Tesla 7.26, is that too stretched for you?
For me personally, I mean,
Yeah.
yeah, but there are, again, it's just my own. It doesn't mean that you shouldn't buy Tesla. It doesn't mean that you should buy Tesla.
Right.
It just means that for my own style, the style that I've developed over the years, it just is too much for me.
Yo, Apple's at 7.3. Here's another part too as we go over this. I really appreciate the insight here. I always like to say, and correct me if I'm wrong, that if you are doing fundamental analysis, you want to compare. I guess it depends if you're trading or because your strategy is different. You want to compare it to your industry, not
No,
necessarily.
I don't like to do that. All right. And here's why. It's not that there's nothing wrong. Is that there's something wrong with it? It's absolutely fine, right? But the reason why I don't like it is actually kind of distorts the value of the company, because I'm not looking at other industries. I'm looking at the company and I'm buying the company. I'm not buying the entire industry. I'm buying the company, right?
Right,
And
right,
so let's say you compare a company to its sectoral median or sectoral average, right? If the entire sector itself is overvalued, right, and the company's trading at a little bit of a discount to the sector, then the company's still overvalued, right? So it's not really telling you anything about the company itself. It's just telling you how the company's doing, how the company's operations and financials are doing relative to other companies and
is
relative to the industry. But the industry could be doing terrible, right? And
right,
so
right.
and they could be overvalued. And so I don't want to compare it to the industry. I want to I don't even compare it. I just generally like to buy cheap. I like to buy absolute cheap,
Cheap.
right?
Joel
Just
is
cheap as
Joel.
possible.
Is there a forward-looking price to sales, or is it just there's just one metric? You know what I
I
mean? Like
think it is, but I also don't. I don't also like that because it's, it's. I can't predict the future.
it's estimates. Yeah. Okay. That makes sense. All right, well, let's move on to enterprise value EBITDA. Is that how you
Ah,
say
I
that?
love this one. This is really, this is the one I look at. I wouldn't say the most. I've kind of diversified now, but this is really something that it's amazing.
Now, what is it called? Is it just price to EBITDA, or is it price, or is it
So it's
enterprise value?
enterprise to EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. I know it sounds like a big word, but it really isn't. It just means comparing the enterprise value of the company to what its earnings before you take into account interest, taxes, depreciation, and amortizations are. Right. So the EV part, the enterprise value is the market cap plus the debt. So when you're looking at the EV to EBITDA, you're not looking at this from a equities investor's perspective. You're looking at this from a the whole company's perspective, because mind you, right, I mean, the company, it's not only accountable, it's not only owned, by equity holders. It's also owned by debt holders. As a matter of fact, debt holders are the ones who get a higher priority in the event that the company goes bankrupt, right? So it's not the owners, it's the people who lend money to you that it's not the owner of the company, it's the people who lend money to the company that actually get priority, right? So we have to take them into account when we're assessing the value of the company. That's why I don't like to look at price just reflects market cap, right? And market cap, it's one component of the company. I like to look at the market cap, the equity aspect of it, and also the debt aspect of it. And that's what enterprise value does. It takes the market cap, it adds debt, and it subtracts cash, right? Because cash is, if I'm buying a company, I'm not buying the cash. I would have to pay for the equity and I'd have to pay
Are
for the
you
debt.
hold on, slow it down real quick. Are you talking about EBITDA or enterprise? Are you doing both?
EV, enterprise value. Enterprise
Enterprise.
value,
Okay, say it
debt,
one more time. Say it one more time. Enterprise value is
market cap plus debt minus cash.
so market cap plus debt minus cash.
Yep. So you can bring up a company. Let's do just bring up a company and we'll try to get the enterprise value of it.
Okay, on this screener, or I don't want to
Well,
mess.
I can actually get something for you.
Here,
So
let
what
me
company
use.
do you want me to get the enterprise value for?
Let's look at Tesla. A lot of people love Tesla on my channel. Let's look at Tesla.
Tesla. All right.
Yeah.
So
Market cap's basically 700 billion plus the debt.
so market cap is 700 billion, and you add 700 billion dollars to 8 billion, which would be 708 billion dollars,
Okay.
8.2 billion dollars, and you subtract the 26 billion dollars in cash. So 708 billion dollars minus 26. What is that?
I'm trying to see what I know you
So
can
it'd be
see.
around 582, 583 um, $1 billion. That's the enterprise value of
Okay, that's
Tesla.
the enterprise value. All right. Are you
Right.
using Trading View also to see that?
No, I'm using Icon.
Icon. Okay, so you could just pull it up quick. All
Yeah.
right, so that's enterprise value, and the value of enterprise value is kind of you're basically taking the market cap and you're just seeing what is the distortion between debt and cash. If it's flat, it doesn't really change. But if you have a bunch of debt, so the debt benefits you in this case, right?
And the enterprise value.
Yeah.
Well, it's
As
not
in
either. It's not a benefit or a non, or harmful thing, right?
yeah.
It it's how do you assess the company? How do you look at a company, right? It's just that's what the enterprise value is trying to do, right? So when
Mhm.
you look at a company, me and you as equity investors, as stock investors, we look at the market cap, right? That's the first thing we look at. That's what we're familiar with, right? When we're saying this company's worth this much, right?
Right.
From a enterprise value perspective, you're not just looking at the market cap. You're also looking at the debt, because the debt is a component of the value of the company, right?
Right.
Because debt holders also have a obligation to the company's earnings and the company's money, right? And actually, they're the first ones, they're the first priority. If a company goes bankrupt, it's the debt holders that get the first priority, right? So it kind of just like if you were acquiring the company, if you were buying, if I were buying Tesla itself, I would have to buy the $700 billion, but I also have to buy the $8 billion in debt, right?
Right. Okay. Yeah. True.
So it just gives you
Minus
a bigger
cash.
picture of the value of the company
Okay,
instead
that
of
makes
just looking
sense.
at market cap.
Now, EBITDA, like I've done some research on EBITDA too. I used to actually write about it, but I never knew it to a key. Tell me if I'm right here. I'm going to take a guess because I like to get criticized. All right.
Mhm.
EBITDA is basically earnings before interest, taxes, blah, blah, blah. So you're basically taking the earnings before I guess you could call it before the legislation or before you add and take away all these what would be the name from
So
just for the
with when you look at EBITDA,
hmm
you're looking at you're looking at the earnings without um, the earnings being distorted by the capital structure of the company, right?
okay, there we go, so you're looking at the raw earnings before the capital structure
Yeah,
applies.
because
Okay.
each and every single company has a different capital structure. Literally, you're not going to find one company by and comparing it to another company and has the same capital structure. You're just not, right. I mean, companies have different debt levels, they have different tax rates, they have different depreciations, how much their assets depreciate by, right? So it's all different. So before you take that into account, you just look at the earnings, and then
And that stands for earnings before EBITDA, earnings before interest from, and that interest is going to come from where it comes
from
from the
the debt they have, right?
from the debt they have there, and
How
also
much
that
interest you have to pay on your debt, right?
that also depends on where they locked in rates, correct?
Yeah, I mean, most interest, yeah, sure. Most interest is variable, so it's not, it's not really, you
Variable,
can't lock it in. It
right?
changes with the interest
And
rates.
that's why you don't like it because you don't want to see that changing fluctuation. You want to see the raw, like it can change, right? It's
Yeah,
kind of a guess.
exactly. It changes
Yeah.
day by day, right? So
Okay. Yeah.
literally, I
Yeah.
mean,
That
like
makes
it's
sense.
literally that is a publicly traded thing, right?
Right.
Like you
And
can
then
go to
taxes. Sorry to interrupt you. And then taxes is obviously that's going to be set by the
your
government,
earnings, how much company you make, how much money you make, right?
how much money you make, right? So that also gets distorted a little bit, right? And
Yeah.
then I have EBIT.
Depreciation and amortization, that's important. So depreciation, it sounds like a big word, but it really isn't. Depreciation is just think of it as, imagine if I buy a TV, right? That TV, I bought it for $1,000. It's obviously going to be worth less, 5 years later, right?
Right.
Due to what, wear and tear, due to whatever, right? It's just because I've been using it and it's worth less, right?
Right.
So what the accountants try to do is they say, okay, we bought this machine, right? It costs us $50 million, and we estimate that this machine's life value will be 20 years, and then each year of that 20 years we divide it by 50 million because we bought it for 50 million, and in 20 years the thing will be, it will be worth nothing. We'll just throw it away. And that depreciation is how much the machine loses in value, right? So it's not an actual cash that's leaving the company's bank account. It's just an accounting trick to look at how much the asset's value has declined over the years. I hope you get it. I hope I explained that well.
Yeah, no. I get it. I just want the audience because here's the thing. I'm familiar with it a little bit, but for other people that are learning, they don't know all these technical terms, which is why I'm trying to just kind of convert them into simplifications. I know it's not simple, but a little more simplifications.
Yeah. So, but going back to EBITDA, I mean, so I know you said your audience likes Tesla. Tesla's EBITDA for the last 12 months was 15 billion, 150 billion, 150 million, right?
Hmm.
So that's before taking into account Tesla's interest, which was 128 million dollars, right? That's before taking that 128 million dollars into account. Taxes, um, the effective tax rate of Tesla, I don't know, somewhere in the 20%. I'm not sure, right? So it's before taking these costs into account that can always change and fluctuate. That's what you look at when you're looking at EBITDA.
Right. Okay. So, and then now the whole term enterprise value to EBITDA, you're looking. So, enterprise value is kind of the fair value. Let's just keep it simple, right? It's kind of the fair
No, no,
value.
sure, yeah, it's the entire value of the company. It's how
Okay,
much
the
the
entire
whole
value.
company's worth, not just the equity, but also the debt.
Also the debt. Okay, there you go. You're adding the debt and the
The
equity.
debt
Okay.
cost. I mean, the debt is a liability to the company, same as the equity is, right?
Right. It's a liability. So, okay, we're looking at EBITDA. I'm sorry, we're not. We're looking at enterprise value to EBITDA. To make it simple, you're really looking at the full value of the company divided by the raw earnings.
Exactly.
Okay.
That's
Okay.
absolutely
Nice.
true. That's how I would describe it, right? So,
Right.
to give an example, Tesla's enterprise value, right, which is its market cap plus its debt minus its cash, would
Mm-hmm.
be 682 billion. I'm sorry, 680, yeah, 682 billion. And you would just take the 682 and then divide it by its EBITDA, which it's EBITDA. And remember the enterprise value, it's the market cap plus the debt minus the cash, because the cash would be, if you're acquiring an entire company, you're not acquiring the cash. The cash would be worthless, right? You're acquiring the debt. You have to pay the debt holders, the people who lent money to the company. You have to pay them and give them back all their money,
Right.
and you also have to pay the equity holders, the people who actually own the company that you're buying the company from. You have to pay them how much the company is worth, or whatever you agree with them. So that's the enterprise value. Um, the EBITDA is, as we explained, just the raw earnings before taking into account these variables that always fluctuate and are always changing by the day, and they're different for each company. And Tesla's is 15 billion, 150 million. So Tesla's EBITDA is 45, right?
Mm-hmm.
That's way too expensive for me. That's very expensive for me personally.
But your style is to pick up
Again,
super cheap.
it's
Yeah.
super. My style is super, super duper cheap, right? So for a lot of people, this is because
You're
again,
you're pick. Hey, look at. He's picking up companies that are about to go bankrupt, basically.
I'm
So
a they call me a cigar butt investor. Literally, I'm looking for cigar butts. I'm not buying actual cigars. I'm picking cigar butts from the street, right? So that's the kind of I'm dumpster diving, if you will.
he's looking for people that are like literally in a coma. Companies in a coma about to pass out, looking for the value.
Yeah,
All right. Okay. So next, this is I love it. I love it. So price to book, and tell me if I'm kind of accurate. I'm trying to simplify the language for the audience. Price to book is going to be how stretched is the price versus the total assets,
exactly. Yep,
and then price to sales. How stretched is the price versus its revenue,
exactly. Yep,
and even EBITDA. I'm sorry, enterprise value to EBITDA is how. Damn, I didn't really think about this. How stretched is the value versus the raw earnings?
no, it's just comparing. Yeah, sure. It's just, again, to add on to that, it's just comparing the entire value of the company, not
Mm-hmm.
just the market cap,
Right.
right? But also the debt. So it's the entire value of the company, right? You have to look at the when you're looking at enterprise value, you have to look at it from, I'm actually buying the entire company,
Okay.
right? That's the perspective you have to look at. You have to not look at you don't have to look at it from I'm buying a share or two shares. You have to look at, I'm buying the whole company and I'm acquiring it. And what would you have
Okay.
to pay for it if you're acquiring the entire debt? I mean, the entire company. You'd have to pay for the equity, and
Mm-hmm.
you'd have to pay for the debt, right? So the enterprise value to EBITDA is the entire company compared to its raw earnings.
Right. So, and again, I'm trying to simplify it. It's to most people, they're gonna be like, "What the hell are you talking about? How stretched is the value?" Right? Isn't that the question
The
we're asking?
entire value, not just the
Right.
value of the equity,
Oh,
but
the
the
entire value. You
whole,
want to
the
use that
whole
word?
value of the
Okay.
company.
How
How
stretched
stretched?
is the entire value? Everything. The
Everything.
debt, the cash, the market cap. How stretched is it versus its raw earnings before the capital structure?
I couldn't have summed it up better. Yep.
Okay, look at this guy's teaching me how to do analysis. Hell yeah, because I'm doing a course right now, and my weakest point is probably deep fundamentals. Like I understand fundamentals to a
Mm.
degree, but I don't understand it in depth the way you do. So hey, let's go. I have to give you a royalty. Sheesh. All right. All right. So next, price to free cash flow. Here, I'll pull it up on. Let me
This is a
pull
lot
this
more
up.
simpler than EV to EBITDA.
All right, this is all the way to the right. So we got price to book, price to sales, enterprise value to EBITDA, and then price to free cash flow. This is his fourth most valuable metric here.
And I really can't decide which one I like more because each and every single day I'm like I like that one, I like that one. So but this one, cash is very important. I mean, ultimately that's what the company is trying to do, right? It's trying to make money, right?
Right.
And it's not about earnings, or it's about the pure cash that comes in from your operations. So what the price to book, and it's much simpler than EV to EBITDA. It's just, where's your price? How much is your company worth compared to how much cash are you making, right? So cash is different than it's different than revenue. It's different than revenue and sales are the same, right? It's just two different words for the same thing, right? So when I say revenue and sales, no, I'm just describing the same thing. Um, so cash flow, and it's much different than how much you make by selling stuff, and it's much different than how much you make after accounting for the costs and the expenses. Cash flow is the actual cash that comes in or out of the company, the actual cash, right? So we're not taking into account anything. It's just the actual raw cash itself that comes in and out of the company. And so cash flow is, I don't know if I can go through the whole formula here, but cash flow essentially, the formula is your sales minus your costs, and then you'd come to your operating income, and then you subtract expenses, operating and non-operating, cash and non-cash expenses from your operating income, and you get to your net income, and then you add back depreciations to your net income, right? Because and this is a little bit tricky because um, depreciations, right? We talked about depreciations, which is how much your assets decline in value each and every single year, right? Again, it's not an actual cash that's leaving your business. It's just an accounting trick to try to assess the most accurate, right,
So wait,
value of
wait.
your
So you
assets.
got you got your degree in account. You're pretty familiar with accounting.
I am pretty, but this is I'm not. I haven't. I didn't. I mean, when I learned finance, I mean, I did take accounting courses and whatnot when I
Right.
went to school for accounting. When I went to school for finance, but most of my accounting knowledge is just really just over the years, just doing this, right? You kind of pick it
Right.
up.
So what you're and I wanted the audience to think about this. The reason fundamentals are so important because for me the fundamentals tell you what the hell is actually going on, because
It,
a lot of people just pick a company, and what it sounds like is a lot of these metrics, and they're either objective or subjective, right? They're hard data or they're more soft
it
data. They're more subjective, and so people can manipulate the financials right through this depreciating asset crap, right?
Oh, absolutely. I mean, there, you have a lot of companies which try to. If you want me to talk about this, which try to actually they try to, I guess you can say, practice accounting shenanigans. They try to do illegal stuff by trying to make sure that trying like they want to raise their share prices by making their numbers look good, cooking their numbers, right? So one of the ways they can do that essentially is by decreasing the depreciations on the income statement, because on the income statement the depreciations, which are not actually cash expenses, right? They're called non-cash expenses because they're just
Mhm.
an accounting trick, right? um, uh, but on the income statement, they're actually they are an expense, just like your other expenses, right? Just like your marketing expenses, your right, they're an actual expense. But what these fraudster companies, what they try to do is they kind of dramatically decrease their depreciations, therefore increasing their, because the depreciation is an expense, right?
Right.
Thereby increasing their income and looking their earnings per share look good and whatnot. And you really can't put your number on, you really can't put your finger on this because it's Who's to tell them that, yeah, their depreciation is not worth as much,
So
because
let me give an
it's just
example.
the best estimate of your how
It's
much your
almost like a
assets are worth in
man.
a year.
It's almost
Right.
like a man, right? He's a bodybuilder. He's pretty strong, and he's 40 years old. He looks like he's still in shape, like he's in his 20s. But really, can you really see the depreciation of his hormones? Can you see the depreciation of his insides, his guts? You have to
Well,
do more investigation to really know, right? Because he could cook the books, and on the outside, it looks good on the outside, but really, if you dive in, you're like, wait a minute, this dude, his liver's broke. You know what I mean? I'm trying to give an example.
Well, absolutely. I mean, again, to go back to the example I gave, the TV
Mhm.
example. So for example, I'm a very frugal guy, right?
Right.
The TV I have right now, which I'm sitting in front of, I bought it in 2018, right? Late 2018. So let's just say 2019. I bought it in 2019. It cost me, if I'm $2,000, I think, right? It's obviously not worth $2,000 today, right? Obviously, right? You wouldn't buy this TV. You wouldn't buy it. No one would buy this TV from me for $2,000, right? No one
Right.
would buy it from me. But if I tell you that it's worth, I don't know, 1,800, you probably still wouldn't buy it from me, right? But again, it's not actual cash that the TV is producing, right? We can't pinpoint how much the actual TV is worth. We can just take a guesstimate, right? The best estimate, right, of how much the TV declined in value, and then we can come to agreement of that.
Right.
So it's non-cash stuff that that's imaginary, I guess you can think of it, right? It's the decline of the use value of the TV, right? Obviously, the TV is in a much more it's in a worse position than when I first bought it, right? But you
Right.
can't really formulate, and you can't really objectively measure how much worse the TV got from, say, when I bought it in 2019, right?
Right. Right. Okay, that makes sense. I'm gonna show an example. So a lot of times they cook the books by making it less, by reducing the
Yeah.
depreciation.
If you can, and this is it's one of the best books you can really read if you want to, just kind of, it's not, the book is not mainly focused on accounting, right? It's not focused on the basics of accounting, but it's focused on how to identify cheaters and people who are cooking their books, right? Which is very important to know, right? I mean, we can know basic accounting principles, right? We can know what these terms mean and how to play with them, but it's also really, you'd have a potent tool if you knew also how to identify irregularities and kind of stuff that don't
Hey,
stuff
look,
doesn't
Joel,
add up,
Joel,
right?
these guys are never
Yeah.
gonna do that. So I'm just gonna give them an example. Okay, this is why you have to do the investigate. This is like a company cooking their books, right? You're on the right side, and then you're like, what the hell? You look underneath, it's like makeup. It's like makeup, putting on makeup. They can cook the books. This is your example right here. What the, you know what I'm saying? It's like adding makeup
Yeah, I
and
mean,
increasing your value, but really it's like, if you take it off, it's, you're not really there. So that's
I
kind of
mean, when they have the makeup on, who's really to tell them how pretty they are or they're not, right? I mean, they have makeup on, right? And you can't really put a maybe you can, but you can't really put a cash value onto that.
Well, I'm saying in general, in a different market, for as a comparison,
Yeah.
right? In the sexual market value, like
Yeah, and
makeup
then that's why I
increases
said you
your
probably
value.
can put.
Makeup can increase your value, and I'm not saying makeup at all. Just there's some drastic, like what, you know what I'm
Absolutely.
saying? There's some drastic change, especially on like Instagram for dudes in general. There's all these apps to manipulate. So you're manipulating the value of the company, is what I'm getting to. You can. So you got to know how this works, right?
Yeah,
Like,
you're just engaging in fraud. Really, that's what it comes down to. It's just fraud, and a lot of
so
people
hey,
get.
wait, let me ask you, Joel, are women engaging in fraud nowadays?
What do you mean?
With the insane the insane manipulation on their bodies and their faces.
I mean, I really don't know about that, but
No, I'm just playing with you. I'm just
on the
playing.
books, maybe they
I'm
are.
just
I don't know.
messing with you.
It's
Yeah, yeah, go ahead. No,
you
no,
go to
I'm just trying to
Instagram,
give
you
a
see a lot of
comparison.
different. You go to Instagram, you see a lot of very questionable things. I just want to say that. So, but really on the
Yeah,
books, I mean, it's just fraud. Really, that's ultimately what it is, right?
right. Okay. So that's price to free cash flow, is how stretched is the price, and that's pretty complicated. How stretched is the price towards their free cash flow, value, free cash flow. Uh,
And just free cash flow, right? I mean,
okay.
again, free cash flow is operating cash flow minus your capital expenditures, right? And
Hmm.
operating cash flow is just your net income minus all the you add back all the non-cash expenses, right? What do I mean by add back? I mean, again, if your depreciations, which are an expense, if they're $1 million, right, on the income statement, they're going to be an expense and they're going to be subtracted from your, your
So,
earnings.
when you say add
But
back, though, you're really mean minus because you're really subtracting it.
exactly, yeah, you
Yeah.
just
Okay. Okay.
yeah, you just subtract them, right?
Right.
But when you subtract a negative, you're going to get a positive, right?
You're gonna get a yeah, exactly.
So yeah,
So, oh, wait, you're gonna get a positive. You're subtracting the I thought when you
yeah,
subtract.
you
Oh,
can't
you're
subtract the
adding. My bad.
negative,
My bad. My bad.
right?
You're
Because it's a
adding a
negative
negative.
on your
Yeah,
accounts.
yeah. Okay. Hey, this is why people are good at math. Okay, so so your free cash flow is basically your revenue bottom line. You minus all the crap, right? You're getting your bottom line revenue,
Oh
and
yeah,
then
you
which
mean
is operating
your earnings, right? Your net income, right?
your
All
net
your
income.
sales, all your expenses, your costs, everything you subtract it, and you get your
Yeah,
net income. But
minus
then
the
you have to
expenses.
no, you have to add back your non-cash expenses, like your depreciation.
But that's an expense, right? You're
But
still
it's
removing
non-cash,
it.
right? Because the cash flow, as the statement,
No,
as
no,
the
no.
name
You're right.
says,
No, you're
it's
right. You're
cash.
right.
It's mainly
I'm.
dealing with cash.
You're right. No, no, you're 100% right. I'm just trying to simplify it without the language, which is basically it's net income minus all the expenses, which includes depreciation.
Yeah, no, it's net income minus because the net income you get your when you get your net income, you already subtract everything else, right? That's your
Hmm.
net. But then you have to add back your non-cash expenses because on the cash flow, it's not really concerned with that, with
Hmm.
depreciation and all that, right? Because that's non-cash. It's not cash. The cash flow focuses on cash, right? So you add that back, and then you get your operating cash flow, and then you subtract your capital expenditures.
Okay.
Complicated, isn't it?
It is. It's just a lot of word language. So
Eh,
I'm trying to
yeah,
paint a picture to simplify it, like because some people are not going to do the full investigation. They just want to
because
know.
you usually it's the net income is a proxy to operating cash flow. So what if you really in the beginning you can just look at the net income minus capex, and then you can get your cash flow from there.
You can get your
It's
cash
a
flow.
rough estimate. It's not exact. You can get a little bit more
Right.
exact. That's a little bit rougher.
Okay. Now, all right. So let's get back to. Let me show that screen again, because now we want to see your actual values. And this is a full course, bro. This is a course on fundamental investing here. Got a damn full course. All right. So I think here you can actually manipulate. What do you
Yeah.
want to see? So let's go below what? Price
What
to
is
book.
that? I can't see that.
This is
Price to
price
book.
to book, and it
Yeah,
says
yeah.
below
Below one. I like it below one.
one. I just push enter. Oh wait, I don't even have to
Yep.
push enter.
That's.
Okay.
You
Where the
move to
hell
the
did
side again. Yeah, I
where did it go? Did I mess up here?
think you did.
Hold on. Let me see if I can go back.
Well, yeah. I think. Well, I think if you go back and click at the three dots again down there. Yeah. No, the three. None of the other three dots below. Yeah, those ones. And then just type the price to. Well, no. You have to
Oh,
leave.
you want to keep those on there?
Well, yeah, they're just they're.
Okay.
But you click at that those three, and you search up price to, and then click on the book. Yeah,
Which one
the
is it?
fiscal year,
Oh,
because
fiscal year.
the fiscal year, the MRQ is 6 months,
Okay.
so middle of the year. So don't click on that one. And then you click on the price to free cash flow.
Oh, it's already on there. I see. Price to free cash flow. There we go.
And then
Okay.
price to sales and
Price to
price,
sales. Price
and then
to.
EVD, but yeah, enterprise value.
Why isn't that one showing up on there?
Well, because you have to search up enterprise value.
Okay.
Get the first one. So we can kind of manipulate them, and you can see the universe I deal in with right now. It doesn't mean I'm buying these companies all, but this is the universe I deal in with. If you click on click
Hold
on the
on.
filter, and yep, there we go.
Okay, there we go. All right, so 1.
Below 1, yeah. And
There we
then
go. All right, and then
then
free cash flow. What do you want?
below 5. I generally like it trading at below 5x.
All right, 5, and then let's go price to sales.
I like that below 1 also, but generally I like it below 0.5. But yeah, that 1 is fine.
We'll go 0.5, and then EBITDA. What do you got here? EBITDA
10 is fine generally.
10.
Yeah. Again, because I got my other one so conservative, I want the EBITDA to be a little bit more expansionary. And yeah, these are the companies I deal with on a day-to-day basis.
All right, so check this out. Oh, you know what? We didn't do market cap. I got to get the market cap down too.
It does. It goes by the market cap. If you just
Oh, it does.
Yeah, if
Okay,
you just scroll all the way down to the.
So I bet you guys never heard of these companies. This is why Joel has different insight here. We got Crescent Energy Company, Xerox. Oh, we've heard of Xerox. Hawaiian Electric, Universal Corporation, United
I've
Natural.
come across these stocks. All of them. I know all these stocks. Across them over the years, actually.
Right. All right. So this is we're back to strategy. Did I have it on here? No, and I didn't. Do we have a question here? Great session, Jay. Fantastic detail. I appreciate it. This guy says, Dimaj, what up, Dimaj? Great session, fantastic detailed knowledge by your guest. Right? Yeah, this dude has some knowledge, bro. He was a prop trader and he does fundamentals. He kind of converted because he found Jesus. No, I'm just kidding. But he has a lot of insight on this stuff. So I wanted to definitely kind of bring some education. I'm learning myself. I love it. I love to learn more. All right. So what is your next steps here? You're looking at these companies. They all meet
And
your
then
metrics.
I really just pick them apart one by one. But generally, what I like to do is kind of actually play with it, and you can go to the section where we played with the enterprise value and then the price of sales and whatnot. And you can actually go from, if you click on it, if you just click on that, well, no, not over there, just the B. If you click on
Just to
the blue,
line it up.
just click on it. Well, it'll show you from
I see what you're saying. You want to get it
yeah,
lined up. Okay.
descending to, and I just like to look at the lowest one. So if you click on it again, you can see starting from the bottom.
Ooh, 0.2. Okay, I see what you're
Yeah,
saying.
and then that's where I kind of start to focus on. So, for example, if I can go with, so I wouldn't touch ITP. That's a Chinese company, so I don't mess with China. It's it's a lot of things, and it's also very small. It's 3 million, so I wouldn't touch that. Right, I generally like to focus on $50 million or above. So I just wouldn't even look any further into that. Customer Maritime, it's a Greek shipping company, and I also don't like Greek shipping companies. All right, so I wouldn't focus on that. CareCloud, I wouldn't focus on that. Zim Integrated Shipping, that's a Israeli, that's an Israeli tanker shipping company, but I also wouldn't touch this one. But I did make a lot of money from that one. But now we're in the shipping is a very cyclical market, right? So it has some years where maritime shipping prices increase significantly and the company share prices increase, and years where they decrease and so forth. But since 2021 to 2022, we had the most ferocious shipping cycle, and now things are calming down. So it's on the trough phase of the Zim. So I wouldn't touch.
Because of the macro things.
Things have slowed down. Where 2021 to 2020 was just a great year for everyone and everything, right? So
let me break that down for the viewers. Basically, from 20, because the supply chains got shut down. When you remove supply, guys, what goes higher? Price. So a lot of these companies who are, I guess, industrials or transportation, their value exploded because they were more scarce. Does that make sense?
Because a lot of people were inside their homes and they got their PPE loans and their stimulants, and they were just buying stuff. So people had to ship these things, and shipping was in high demand in 2020, right? Because so many people were buying so many stuff, and they benefited from that. Cumulus Media, I love Cumulus. I love Cumulus. I love it very much. It's a really good company there. I see.
Chart somewhere.
Yeah, it's I'm up quite a significant bit on that one. It's
which one? Cumulus?
Yeah, Cumulus Media. I love Cumulus. It's a very nice company. But yeah, generally you get the idea. This is the universe I focus on, and since I'm very familiar with, and if you keep doing this for a year, for like few years, you know, you'll just be familiar with all the companies, and you really wouldn't have to pick them apart one by one. You know, you're just kind of
Okay.
familiarized with all these companies, right?
Now, how now this was my question to you because I see what you're saying. This is how you choose the stock, right? This is how you this
Yeah,
is
this
the
is my
what?
universe. Yeah.
Fundamentals is I'm trying to put this together better, but fundamentals is the who is this company? What do they do? You know,
Yep.
who do they do? Technicals for us traders or for us that use technicals is
I
where
use technicals also, but
oh you do.
we'll
Okay.
get into that. We'll get into that. Yeah. But yeah, I mean, generally that's that, but that's just the first. That's the getting my universe is just one aspect of my process with tens of other aspect of it, right? For example, I like stocks that are beaten down. I like companies that are down over 30 to 50% from their 52-week highs. And when I narrow it down on a few companies, I look at their income statement, their balance sheet, and their cash flow. I do a rough, very, very thorough analysis of that. And then I look at their annual filings, because I'm not an expert in all these different industries, right? I'm not an expert in home building. I'm not an expert in shipping, right? So I have to know what these companies do, right? And if you look at the annual filings, they give you a comprehensive. It's federally, they're required by the government to file these forms. The 10Q, the 10K. It's the annual filing, and they're required. So just give you a comprehensive overview of what the company does, what the risks are, who the management is, and just tell you what the company is. And I look at that, and then really I do a thorough analysis of the credit of the company, right? So if the publicly traded the debt, since the companies I'm buying, they're highly leveraged, they're very risky. Bankruptcies for these companies are very high. I think we talked about this on TikTok. Usually about 3 to 5% of my portfolio goes bankrupt, and I'm fine with that. I actually like that, right? Um, when I see about 5% of my portfolio going bankrupt, it shows that I mean 3 to 5%. It shows that I'm doing the right thing, right?
Mhm.
And when I look at the debt, I kind of try to assess from a credit holder, right? Someone who has the debt. I kind of just try to assess, is this company going bankrupt? Because the debt guys are much smarter than the equity guys usually. So I'm like, okay, so is this company going bankrupt? What is what's the yield on the publicly traded debt? What are the covenants on the publicly traded debt? What are the restrictions? What's the interest rate? Just kind of look at the debt from there. Oh, and also insider buying. Oh, insider buying is so important to me. I mean, the insider buying is arguably, I would even say, the most important thing, right? I mean, sometimes I'll just look at the insider buying and I'll just buy it. I wouldn't even look at anything else, right? So insider buying, huge,
Oh,
huge
just
importance.
straight YOLO, just straight YOLO.
Well, that doesn't mean it for every company, right? It's just
Right.
if it's a company that I've been following for I've came across before, I may just look at a little thing like just maybe look at the ratios and see, oh, it's getting just added on the lower end of my portfolio, right? But the
Yeah.
insider buying is so important. I mean, Peter Lynch said in his book One Up on Wall Street, he said there are millions and millions of reasons why insiders management would sell their stock, but there's only one reason why they would buy it, right? And that reason
Oh,
is, they because they can sell it because they want to raise cash. We don't know why they sell it, right? It does. If they sell the stock, it doesn't mean that they don't believe in the company, right? It
right.
can mean a whole host of other things. But if they buy the company, almost always it means one thing, that they believe in the company, right? So that's
People
very important.
people are more likely to sell something out of fear. So if they're buying
Well, it's
it,
not even these aren't people; these are insiders. They're the management, right? The
insiders. Well, I'm just saying
CEOs, the
in
CFOs.
general, psychologically, because this is a psychological metric. You're saying, okay, everything aligns. Oh, they're insider buying here. Oh my God. Okay. Well, somebody knows more than I do, and they're putting risk on the table. That's a big
Yeah,
catalyst for me.
absolutely. Yeah, you summed it up in a few sentences. Yep. They
Okay,
know
cool.
more than me, and they're buying the shares. And generally, what I like to see with, again, you can also analyze the insider buying itself, and you can look at it from multiple aspects. So yeah, I'll always get into that.
Okay, cool, cool. Now how the hell do you pick a like where do you buy at, right? Because I mean, some of these companies, I guess the price is usually lower because you're really using these price to book ratios. But how do you know when to execute the trade? You know what I mean? Like, are you looking like at the technical levels? What are you looking at?
So this is a very good question, actually. The technicals over the past, I don't know, since COVID started, I've been actually,
Give me a
when I
ticker.
started my career as a long-term investor, again, you always develop, right? I started my career, almost 10 years ago, right? And you develop, right? As a human being, we make
Right.
mistakes, we learn from them, we develop, right? And as I kind of developed, I realized that, yeah, I actually can bring some of my trading, my old times in trading. I can bring some of the ideas to long-term investing, like inside, like technical analysis, right? So the when, right? The technicals are, I've kind of incorporated it now, right? I mean, I use the technicals to determine when to buy, right? So,
Right.
but I only look at, it's very simple actually. I just draw a few lines, right, and then just look at the RSI. Really, the RSI is very important, right? So
It
yeah,
is, yeah.
that's really the only two thing I look
Where
at
give me an example really quick. Throw me a ticker other than this one.
for what.
Just throw me a ticker, like any company that you like right now.
Any company that I like right now,
As an example, not it doesn't have to be like the perfect setup. We can back test it.
what you mean by for insider for I'm sorry, for technical analysis, or
Yeah, for TA, I got the charts up right now. So
oh
uh,
again, SMLR, you know, Similar Sciences,
what is it? SL?
SMLR.
Okay. SMLR. Similar Sciences. Okay. Okay. All right. Let's take a look at the weekly here. Now this is probably my best expertise is technical analysis, honestly.
Yeah, I've kind of started to incorporate technicals. Because a lot of value guys would say, "Oh, technicals is pseudoscience; it doesn't work," and then you go to the technical side and they say, "Why would you ever do value now? Why would you ever do tech? Why would you ever do fundamental analysis?" They
I
say
know, yeah.
it's not worth it. So it's like, if both sides hate you, maybe you're doing something right.
Exactly. Yeah, because most of them lose anyway. And also, I mean, aren't we here to add more variables to have more insight? Like if you
Yeah,
were
I mean, I'm always trying to learn, right? If I see something new, I'm always just trying to incorporate that into my,
you
into
know
my
what I
process.
say? You don't do technicals. Okay, you want to buy up here? Go for it. Great. I'd rather buy down here.
I mean, yeah, it's
So here's the weekly RSI. It looks like it bottomed out. This is what I would call a bullish divergence. This is actually this is a really good example of bullish divergence. Let me show you here.
that's
It
exactly
says
what I look for, bullish divergence, right? That's
bullish divergence. Yep. The price is falling while the RSI the buying pressure is actually picking up. There's going to be at some point a break. Where do we mark that break? Well, you look at the the previous high in this case, let me see, RSI is going up, it bottoms. In this case, you want to see a break above the previous level. So that previous level, So the previous level here would be it showed some consolidation at this point. You see some consolidation here at the top. This is kind of like the top of the consolidation right here. So once price gets back above that, you're like, okay, I'm not going to buy it when it breaks out, but I want to see a pullback and a hold of that level. You get a pullback, the candle holds here. Now you want to get in because you're seeing that hold happen, starts to climb back up, and now you're good. That's how I do some TA on that. But that's really good. Okay. It's a good pick. There's other things you could look at too, but sometimes there's just too many things. Price action's your best friend, in general. All right, so that's how you choose. You do a little bit of technical analysis. Now, what was your so far? What was your best? Now, how long are you holding? How long are you holding a lot of these trades? What's your average hold time? What is your lowest hold time? Your highest hold time? Your longest, whatever.
mainly I'm holding for. I don't have a specific hold time, but it's within a range of few weeks to a few weeks. That's the quickest, right? It doesn't mean I'm going to hold every time. So I'm not a trader. But few weeks to 2 years is mainly my. Again, that seems like a very
Broad.
wide-ranging time frame, huh? So, but yeah, really, it could be. I mean, I could get lucky, and the thesis could play out in 2 weeks, and the stock could shoot up, right? Or it could take 2 years for the thesis to play out, right? But yeah, 2 weeks to 2 years.
Okay, so I'm guessing if it pops really quick, really fast, like all right, let me get out of here because I made my value really. I made what I was supposed to make in a year and 2 weeks. Let's get out.
Well, I mean, it really depends. I mean, if I think that it hasn't hit intrinsic value, then yeah, I'd probably still hold it.
All right. So 2 weeks, man. He's a swing trader also
No,
secretly.
I'm not. I'm not a swing trader, but
He's a
again,
low. He doesn't want to say it. He doesn't ruin his
well, no, I mean
brand.
this doesn't happen very often, right? But you can get very lucky, right? I mean, you can get very lucky, and the market could reward you tomorrow. It could happen that I can buy a stock and analyze everything, and then buy it tomorrow, and the thesis could play out the next day, right? I mean, right? It's you never know what the market is going to do tomorrow, right? But again, it rarely happens, very rarely.
Okay, what would you say your averages? Are you holding for like what, 6 months to a year?
Yeah, about over a year, I'd say. Certainly
How
over a year.
how many positions will you have on average within that year?
It really depends on the market environment right now.
Okay. All right,
It's
really depends.
if things are expensive, I'm probably very picky on my portfolio. If things seem pretty cheap, then I'd be very I'd be able to I'd look at a lot of things.
So would you say your best opportunity is when the market has like literally crashing? That's when
Oh
you're
yeah.
looking.
Oh yeah. Oh yeah. I mean, some of my best.
Oh yeah.
It's not even. It's absolutely. I mean, most of my biggest winners, they come during a bear market, right? I mean, I love bear markets. Bear markets they rewarded me handsomely, really. I mean, my best place 2008, 2018, 2016, 2020, 2020. Yeah, I mean, 2020 also very, very big 2020. Yeah, so it's just bear markets reward me due to my strategy, how my strategy works, and my style of investing, right? And my whole framework. It's just bear markets reward me the best.
Let's test you. Let's test you, Joel. Do you remember I call it the tariff bear market, the Trump tariffs, China tariff bear market? Do you remember that one?
Yeah, I vaguely remember. Yeah, I don't pay attention to much macro now, but vaguely
Okay.
I do remember it.
Okay. Oh no, I'm just trying to see. So you said 2008 was your best. That was a big
No, 2020
pullback.
actually was my one of my best years, really. I mean,
See, hey, look, this is a good mindset though. A lot of people want if they're not invested yet, they get invested when the market starts to spike higher. But that's really the wrong mindset. Like
no,
honestly,
I mean, usually what I do is usually when the market is chugging along, and it's going higher, I kind of like to take profit and raise cash, so for the next downturn.
right. And so what I'm getting at is that a lot of newbies, a lot of people who just coming in, they see the charts getting wrecked, and instead of licking their lips saying, okay, what can I get into? They're more so they're afraid. They're waiting for the market to come back up. There's some people who, and I'm saying just in general, there's a lot of people. If you're going to hold for a longer wait time, you want to see markets get wrecked. You want to buy the lows, but a lot of people, they'll start buying when the market makes new highs. And I'm like, hey, you can do it, but your risk to reward is not as good as if it's really crashing. And then they make the excuse, well, the company is really, they could go to zero, but how many companies actually go to zero unless they're doing what you're doing, which is, pretty risky.
Yeah, pretty. I mean, what I'm doing is pretty risky, but again, what I'm doing, it's very risky, right? But you, in principle, right? I mean, they teach you this in business school. In principles, when investors take on more risk in aggregate and also in principle, they demand higher reward, right? So,
Mhm.
like if you're selling this investment product that's two times as risky as the S&P 500. Investors in aggregate will demand two times as much return as the S&P 500. Right? It doesn't mean they're going to get it right, but
Yeah,
what
Joel,
they
they're not doing what you're doing. They're not doing this type of work. They're just literally looking for somebody to tell them what to buy. That is most people,
it's
unfortunately.
most people. I mean, I would say most people. I mean, it really takes a. Again, I'm not saying I'm the smartest. I'm really not the smartest guy in the world, right? I promise you, I'm not, right? I've had my IQ taken. I'm not a super genius. I'm your average Joe, right? But it really takes two things to kind of to pick your own stock. You really have to fit two criteria. Either, um, well, you have to fit them in conjunction. You have to have passion for this. You have to love it. I mean, not many people love analyzing 10Ks, and you have to, if you really look at the 10Ks, very boring things.
Yeah,
Not
that's
many
why I
people,
couldn't do it.
it's very boring stuff. Not many people like this, right? I actually,
Yeah.
it's not. I'm not just. I'm not just doing it for the money. Actually, I like it, as I explained earlier, right? I mean, even
Mhm.
if I was getting paid somewhere close to minimum wage, I would do this for, I would do this because I like it, right? It's very fun to me, right? So you have to have passion for this, right? You have to be fanatical about this, and you also have to have the time for this, right? If you can fit
Yeah.
those two criteria, then you can really go ahead and start to
And I'd
develop
say
your own.
I'd say you
That,
actually have you have an advantage because most people don't like it, so they won't do it. So you have an edge because you actually will keep doing it, right? If it comes to anything hard, most people give up. They give
yeah,
up
I
right
mean,
away.
absolutely. I mean, it's hard. I mean, in the beginning, it's going to be very rough, really. I mean, and also value and also deep value investing. It's not, all when you're building your investing strategy, right? It doesn't matter if it's value investing; it could be any strategy, really. When you're building your own style and strategy, in the beginning, of course, it's going to be rough, right? I mean, that's the case for everyone, right? You're going to have a bumpy road.
Hey, Joel, real quick, keep
Yeah.
going. I'm gonna run to the restroom real quick. I'm gonna put you on. Just keep going. I'll be right back.
All right. So as I was saying, in the beginning of your investment career, I mean, you're going to have a very bumpy ride. That's the case for everyone. But with this style that I employ, cigar butt investing, it's really, you have to have very strong nerves. You have to really be able to, because you can see your portfolio go down 25%. You can outperform for 3 years, 5 years. You can underperform. I'm sorry, right? You can underperform the market for 3 years, 5 years. So you can see everything else shooting in the sky, but you have to have discipline. You have to say, you know what? I see these Apples and these Facebooks and Googles. I see them skyrocketing, right? But I have my own strategy, and I'm going to stick with it, right? You have to do that. You have to be able to, bite your own tongue and say, I'm going to do what I know to do, and what I believe in, what I feel comfortable in, right? I'm not just going to, what do they call it? FOMO, right? And you have to kind of build your own discipline, and you have to be disciplined. You really have to be disciplined, especially with this strategy. If you're employing something akin to this strategy, you have to be disciplined, more disciplined than anyone else. You just have to be.
What would you say were your biggest mistakes in your career?
Biggest mistakes, really in the beginning, I mean, I would say not doing enough. Yeah, in the you know what I would say? I would say, you know emotions, really, I would say, right? It's about confidence, having putting my money into things that I didn't have confidence in, things that I just, everyone else is doing it, why don't I just do it, right? And when you do that, when you just buy what other people are buying, and when you let your emotions guide you, and when you put your money into places based on your emotions, you're gonna make mistakes, and you're not gonna feel confident in it, right? And if things go against you, you're going to get really scared, and you're going to make bad decisions, right? So it's really about you know confidence, right? Having confidence in my own ability, right? No matter if I fail or succeed, right? Confidence doesn't mean that you're going to do great, right? It means that you believe in your process.
Right. You can't think logically if you're falling in love.
No, absolutely not, right? So believing in your process, very important, right? But also, just another thing is just doing and this is really important, right? I mean, it's doing everything in your game, everything in your arsenal, everything within your own parameters, to stay in the game, right, for as long as possible. It doesn't matter if your portfolio gets wiped 90%, but if you can stay in the game, you know, it's that's all you really have to do. Just stay in the game for as long as possible. For you know, for until you get it, to stay in the game. Really, don't get wiped out. And the only way you can do that is if you focus on downside. Your first, second, third, fourth, fifth, and even sixth concern should be, what's my risk? Your risk should be your first concern. It should be your primary concern. What's my risk? What's the most amount of money I can lose on this? How much money am I willing to lose on this? Right? Objectively, the upside, you shouldn't really even, when you're beginning on this, you shouldn't really even worry about the upside. The upside will take care of itself. But if you have the downside protected, if you have downside protection, you know, don't worry about how much money you can lose, not how much money you can gain. Right? That was a really big lesson I learned.
Okay. Hey, that's very important. People need to hear that. Examples, they always, you know, sometimes you need a real example. Sometimes you got to get burned to learn. I don't know. Have you experienced that? You got to get burned to learn.
Yeah, I've experienced it many times. I mean, it's again, investing in oil at cyclical highs because, again, right, you know, someone told me to buy oil, right? I mean, oil's going higher, right? I was hearing in the news, I was hearing it on CNBC, Bloomberg, oil is going to go very high, right? I was like, okay, let me buy some oil,
Right.
and it was
Right.
at their cyclical highs, and I got burned, right?
Which is why we do the cycles are very important, right? Secular trends and cycles.
Yeah, I
Um,
mean, my biggest returns were really on cyclicals, right? But after I kind of started honing in and kind of getting my understanding of cycles of different industries and how they move and whatnot, right? You know, that's where my biggest returns really come in.
okay. Great. Now let's transition a little bit. You've given us so much, Joel, so much insight and knowledge. Let's do something a little more fun here. First, what is the number one book you would say that if you're a new investor or maybe you're in the game? Because look, we're always learning, right? It's not like we've made it. It's the market's always changing. What's a solid quality book you would advocate for somebody to read?
A solid book.
Yeah, what's a solid book? Something of knowledge, right? Maybe it's a document. I don't know.
You know, I want to say the intelligent investor, but we already brought that up. I don't even, I really don't know. I mean, just read, you know, if you're interested in a company or whatnot, it doesn't matter if you're interested in a stock, just read the 10Ks. I mean, the annual financials, just read the annual forms. It's really the only things I can say. I mean, if
A
you read the annual forms, you can really understand the company from a whole different perspective.
That's true.
As a matter of fact, I'll be honest with you, right? If you read the 10Ks, and I'm not exaggerating when I say this, maybe I am to a certain degree, but really, I mean, this is the case. If you read the 10Ks of a company that, you know, a stock you're interested in, you've done more work than 99% of Wall Street, right? I mean, Wall Street, we tend to think of it as and I know many people who work at Wall Street. I've been there many times. I've had clients there. You know, I've had customers where I've you know, so uh, it's really not a place where people go to invest. It's a place where people go to sell investments, right? So they're not really doing fundamental analysis, real actual investing. They're just selling investments, right? So if you read the 10Ks, you've done more work than 90% of Wall Street.
We have a subscriber that says, "Is there any sectors that you avoid getting involved in?"
Yeah, I do have some sectors, mainly because, you know, not because I don't, you know, not because I don't like them, right? I have no affinity for them or whatnot, but it's mainly what I can understand, right? Financials, for example, financial services, banks, and you know, just anything that has to relate with financial services, right? So PayPal, banks, maybe a company like PayPal, maybe, but financial services and investment banks and wealth management, you know, any bank, really, right? So any company that's within the financial services, I avoid. I don't deal with that sector entirely.
Is it because they can cook their book so well?
No, it's just it's an industry that's very complicated. I can't understand it, right? It's
Okay.
if you can understand, if you're a banker and you've been a banker, or if you understand the banking industry, right? By all means, really, I mean, you have an edge there, right? So
Right.
you can
Okay,
build
that
on
makes
it.
sense.
But I always figured out, I always get burnt on that, and I just can't really understand it when I'm doing analysis on them. I can't understand. I really just can't understand them.
Um, Joel, what is your daily routine, if you don't mind telling it? What is your daily routine? Do you exercise? Do you diet? How do you stay focused? Can you hear me? I don't know what happened. Was that was that question too intrusive or what? What's up? Maybe his phone died. Don't give up on us now, Joel. What's up?
Yeah, can you hear me?
Yeah, there we go.
Or
There we go. Dang, I thought
okay,
you
yeah,
ran. I asked you, do you exercise? That dude dipped out. Sheesh.
yeah. No, I keep getting calls
Oh, okay.
but no, it's fine. Yeah, I mean, I do exercise. I do go to the gym every other day. My routine is really wake up 7 in the morning, right, before market starts, and this is what I do for a living. Mainly, I'm managing my own money, so thank God it's everything's working out well for me. I'm really grateful. So yeah, I mean, it's workout. I really do like to work out. You know, get on that
Ooh.
bench. It's
Hey, yo. Do you lift weights? Do you
yeah,
do you lift weights? Okay. Hey, look,
yeah,
y'all gotta lift weights, bro. Look, you see what I'm saying? You guys gotta get in that weight room.
yeah.
Start
Do
lifting some
full
weight.
body exercise. I do a full body exercise every other day. So
What's your favorite body part to hit? You know how you guys be getting that fit, like the best.
I love the legs. I mean,
Okay.
I know a lot of people hate the legs, but I mean, I hate them when I'm doing them, but after it's
Yep, that's how it
it's
is.
you know the pain is it's a it's one of those sweet kind of pain, so I like it. Um, so yeah, I mean, I exercise. I do. I don't do any meditations or anything like that. As you can probably tell, I'm a very logical guy, so I don't really focus on a lot of spirituality or whatnot.
I
Right?
mean, bro, you're literally meditating on the 10Ks. Come on, let's keep it real.
Yeah, I am. Absolutely, you're absolutely not lying. I really am.
We don't do that meditation / manifest. No, we don't do that crap. We got to think, right? We can't manifest more money. You got to do the damn work. All right. So diet. How's your diet? What do you eat? Do you leverage your diet to your? Have you noticed anything you eat slows down your focus or?
I mean, I do have a very strict diet. I mean, mainly eating healthy foods. I mean, mainly eating high protein, high carb food, right? Mainly because I'm going to the gym so much, right? I do need that energy. And my diet is pretty strict. I mean, no fast food really. I don't eat fast food. I haven't eaten fast food in how many years? I can't even remember.
Yo,
Right? No, no candy, drinks, whatnot. Right? So no smoking. I don't drink. I don't smoke.
Yo, this is not like I can't say this enough. People who are successful on their own, who are able to make it, I know it's like, a needle in the haystack, but those people have impulse control. This is your prime example. I didn't even expect you to do that. This dude exercises, the dude keeps his diet, he doesn't drink, he doesn't smoke, he doesn't party. If you guys are gonna be successful, you gotta do hard
Well,
things.
I don't have time to party. I got to raise a child, so
Gotta be disciplined though, right? You gotta be disciplined.
yeah,
You're not gonna be successful if you're not disciplined, period.
yeah. Discipline is very
Shout out
necessary.
to you, bro. Hey, shout out to you.
Thank you,
That's
thank you.
important because you can't really enjoy life if you're falling apart, right? If you have to go, I always say, hey, if you don't take care of your health and spend the money and the time it takes to take care of your health, you're gonna pay for it at some point with disease, especially with this diseased country and the foods. You're gonna pay for it with a big bill at some point. You know what I mean?
I mean, yeah, I mean, so me personally, I'm too selfish for myself to actually go smoke or drink or whatnot, right? I mean, it's I feel like I have an obligation to myself to take care of myself as
Right.
best as possible, right? It's not just something I want to do, something that I feel like I need to do. It's an obligation. So
I mean, that's the good selfishness though, right? You should be
it's a
selfish
good
to
selfishness. It is,
optimize
yeah,
yourself. Yeah.
it
Okay.
is. I mean, I can't allow myself to do a lot of this, very dangerous, very, long term wise, very unhealthy things that could
What's your weakness?
decrease your. life expectancy. I care for that stuff. I want to live as long as possible. So
What's your weakness?
it's my weakness.
Yeah.
Ooh, that's a very good question. Weakness of mine, and I guess you can probably also, you'll probably agree with this, but really, I for the better part of decade or a half, right, decade and a half, I've always been very, very non-emotional, right? And when I say non-emotional, I mean, I don't mean that I'm a psychopath, stone cold, but it means that I wouldn't pay attention and I wouldn't prioritize, my mental health, my emotions, right? Because I was so focused on logic, reasoning, and facts and objectivity, right? That I've started to lose sense of, you know, who I really was, right? What I
Hmm.
cared for, right? The things that make us human, right? I became a robot for over a decade, right?
Right.
And that took a toll on me. And you have to objectivity is good, it's necessary, but you also have to allow your emotions kind of to lead you sometimes, right? Your emotions are good indicators. Their emotions, they're subjective, sure, but they're very important, right? So allow your emotions to actually take some time, some I don't know what the word is, but allow
Like,
your emotions to take some leading role in your life, right?
yeah,
You have
don't
to,
listen, like I would say
don't neglect it.
don't let your emotions lead you, but don't act like they don't exist. You have to still listen to them, process your emotions. You want to process it, but that doesn't mean spend 10 hours and do not be led by your emotions, right? You will lose in life, especially as a man, but
Yeah,
make
yeah,
sure
no,
you
but
don't
you have to.
ignore them. Don't ignore them.
Yeah, don't ignore them. You have to give them some space in your life. You do.
Right, right. Okay. Nice. What about your diet? What's your weakness when it comes to your diet?
It's really not a weakness. I'm really my diet is it's really no weakness on my diet, right? I mean, I eat, I eat like I'm very, very on my diet. The diet, I'm very strict on my diet, right? Over the years, I've been very, very strict. I mean, you know, uh, getting organically sourced food is very necessary. I mean, you can't eat GMO stuff, right? You have to alcohol, anything that's banned in the European Union. It's there are some items, some food stuff that's banned in the EU that we have here. I don't eat those, right? I looked into the EU's, version of the FDA. It's much better than ours in terms of consumer health and whatnot, right? So I look at their food recommendations and product recommendations, and so it's what they recommend and what they recommend not to eat. I look at that, right? So food that could have some sort of effect on your health, even if it's if you there are some foods where if you eat them for so long that they could have some adverse effect on your health. I don't touch them, right? So there's really not any weakness on my
Okay. Hey, you're just a focus. You have a growth mindset, man. I noticed that a lot of you have a growth mindset. You focused on mostly like you're blocking out all the stuff that could lead you the wrong way, and you actually find it sounds like you find enjoyment in actually just improving yourself. Period. You find a lot of enjoyment in that. That's a mark of a successful person. All right. Well,
I
let's.
mean, you have to really. I mean,
Yeah.
you really, because again, this is the objectivity part that comes in, right? You just
Mhm.
have to really measure, right, your actions that you take, right? What are the long term risk to reward, right? How will you benefit from this, and what risk will this pose to you, right? I mean, right? So you just kind of have to judge this, and it's really about your expectations, right? I don't expect everyone to live my lifestyle, right? Just as I don't live everyone else's lifestyle, right? But
Right.
depending on your expectations, if what matters to you is having fun and being careless, not to the point where you hurt yourself, but kind of being a roamer, right? And by
Right.
all means, right? It's about your expectations and how much you're putting into them, right? My expectations are I want to live a happy, peaceful, long, healthy life, and I do the best that I possibly can.
Okay. I'm gonna do a quick. Any shows that you watch that you enjoy? Is there any shows that you enjoy like on your leisure time? Do you watch shows? What do you do for leisure? What do you do for fun? Do you watch shows? Do you golf? What do you do?
Yeah, golfing very, golfing. I do love to golf, but I haven't been golfing over I've just been focused on the gym lately, right? So I haven't been golfing that much. But entertainment, movie and television wise, it's I do watch a lot of TV shows and movies, right? Especially the newer ones. I do like the newer ones, and also the movies. The movies are nice, but yeah, the movies are very nice. I do like the movies, right?
What do you watch? What do you watch? Tell us. Give us the show.
I don't watch shows, but I watch full movies mainly.
Okay.
So I like Quentin Tarantino's work. Uh, Dennis Villeneuve. I don't know if you've heard of him, but great director. I do like his works. So yeah. I mean,
What's the last best movie you saw in the movies?
that's best movie.
Oppenheimer, huh?
I haven't seen that one. I haven't seen it yet.
Ooh.
So I haven't seen. Yeah, I haven't seen that one. But I would say Once Upon a Time in Hollywood probably is.
Okay.
I don't know if you've seen that one, but terrific movie, really. Quentin Tarantino.
Quentin Tarantino. Yeah, I got to see that one. I keep hearing. Actually, let me write that down. What is it? Once Upon a Time in Hollywood. I like Quentin Tarantino's. What was that show back in the day? Pulp Fiction. I know you know Pulp Fiction.
Oh, Pulp Fiction. That was such a terrific movie. I mean, it was
loved it. I watched that so many times.
Yeah, I'm not really the type of person to watch movies more than once. I like to watch it, once and I'm done.
Neither am I, but I was a kid, man. I don't do that anymore. But as a kid, when I first got hooked, I was like, why do I like this? And I'd watch it with my cousin over and over. Now, hell no, I'm not watching the same movie. But it's more like
nostalgia. Nostalgia. Yeah,
nostalgia.
And it is. I mean, there are some movies I'll bend that rule for, but yeah.
Yo, what was it called back in the day in Hollywood? What?
Once Upon a Time in Hollywood.
Once Upon a Time. Okay, there we go.
The Hateful Eight is also a great Quentin Tarantino movie. I mean,
bro, you're like my cousin. That's what he watches. He always gets me on these Quentin Tarantino things.
Yeah, I like Quentin. Quentin is it's just an explosive director, really, right?
Yeah. Oh yeah. You got to see Oppenheimer. I don't know if you're in that kind of stuff. Like
I am. I do like his work. I forgot the director's name, but what's his name is? But yeah, Inception, Memento, The Prestige. I mean, I've watched all of these movies. I do.
Shutter's Island. You seen Shutter's Island?
I don't think he made Shutter's Island. I think that was
no. He didn't. No, he didn't make that. I'm just wondering.
But yeah, I have seen it. It's a terrific movie. Really, what a plot!
I love those. Those are my favorite movies. What the hell is happening? How do I figure problem solving? Right? You're trying to figure out how did this?
Yeah, work? No, very mysterious movies. Very movies that are not clear cut on their outcomes.
Yo, you probably get bored then, huh? Stuff that you can already see was gonna happen. You're like, hell no, I'm not watching this.
No, I actually spoilers really don't affect me. I mean, I like to kind of get into the movie,
Okay. All right. Well, guess not. All right. Well, I'm gonna throw a couple names. Give me your first reaction to this. Make it kind of fun here. Okay. So I'm gonna give you a name. Just give me a one-word answer.
All right.
All right. Donald Trump.
Stupid.
Joe Biden.
Okay.
Elon Musk.
Arrogant.
Taylor Swift.
I singer. I don't know. Yeah, singer. I don't know about
okay. Artificial intelligence.
Hyped.
Blockchain technology.
Also hyped. Yeah. Hyped.
Warren Buffett.
Intelligent. Terrific. Very, very. Yes, intelligent. Really. I mean, the guy's he can do so many things. It's crazy.
All right. Well, that's all I got for you, Joel. I appreciate the podcast. It was fun. We got to do it again. A lot of good insight. I'm gonna definitely mark this one up. Is there anything you wanted to leave with the? Oh, you know what's a number one question that people? I want to ask you this question just to level it off for the audience.
Yeah.
How would you conceptualize, how do you beat the stock market?
How do you beat the stock market?
Yeah, in a short, I know you can't give the whole thing, but how do you beat the stock market?
With the stock market, I mean, again, it really takes a special kind of person to beat the stock market, right? Again, as I said, not a smart guy. You don't have to be. You don't even have to be, a genius. You don't have to. You can have average intelligence and still beat the stock market, right? But it's about what you'll put into, because, and for most people, I don't think it. I don't think it's necessary for them to try and beat the stock market, right? Because most people are dealing with their day to day life. They have children. They have school, work, right? So they just don't have the time, most people, right? But if you do have the time and you do have the ferociousness to beat the stock market, right? I mean, what you just, I'll say buy companies that are, that are cheap, right? I mean, but you know, I'll summarize it in 2 or 3 sentences, right? Learn how to value a business, figure out what a business is worth, then buy it for a lot less, right?
Okay.
If you can do that consistently, and also be disciplined, really, right? That's really simple, right? Learn how to value business. I know how to value businesses because, not because I'm, intelligent or whatnot, right? But because I did this through trial and error and just kind of learning, right? And anyone can do what I do, right? It's just they have to have the dedication, the fanaticism to it, and they have to have the time. I've had a lot of time, fortunately, right? Decades, right? And so, really, that's all I can say, right? Figure out how to value businesses, and if, figure out what a business is worth, and buy it for a lot less.
100%. Somebody wants me to try to convince you to buy Chainlink, but that's a different day. We'll do that another
Buy
day.
what?
Buy Chainlink. It's a crypto technology. It's not a blockchain. It's not really a crypto. It's an infrastructure for all of blockchain technology in general. They want me to try to convince you. They basically not like a debate, but kind of how that goes.
Mm.
So anyways, Joel, yeah, hey, I don't want to take more of your time, man. I really do appreciate you coming on and sharing all the knowledge. This is what people need.
Absolutely. I mean, I really appreciate the platform, Jeremy. A really fantastic discussion. Really, I mean, we got through a lot, didn't we?
We did. Next time we'll talk macro, kind of what you're looking at as an investment, possibly get a little more exposure, man. All right.
All
Thank you
right.
guys.
Really
Thanks.
appreciate
Talk to
the
you guys later.
platform. You have a good rest of your day.